The backdrop to the European bond market is still one of very low economic growth and low inflation, which means the ECB is likely to keep interest rates much lower than in the United States for a very long time. The consequence of that is that bond yields generally have been moving lower, even in the peripheral countries. In Spain and in Italy, government bond yields are now at their lowest levels since before the European crisis. So that poses a challenge to bond investors, where to get a decent yield, where to get good return. And I think there are several places in the market we can continue to look. The first is in those peripheral government markets themselves. Italian debt and Spanish government debt still provide a much higher yield than in German government debt, for example. So for many investors, this should form a core part of their fixed income portfolio. A second place to look is in the high yield market. These are corporate bond issuers that are rated below BBB. They're good companies, they have solid balance sheets, a lot of cash flow, but they pay a yield which is much higher than investment grade corporate debt. And there are many opportunities still across different sectors to get a decent return from high yield bonds. And the third area I would say is in the financial system. Bank debt is still quite attractive relative to company debt, to industrial company debt. This is because the market still perceives that there are some risks associated with the banking system, but we believe the banks are getting stronger, they're raising capital, and their balance sheets are in much better shape than they were 2 years ago. Therefore, they can afford to pay the higher yields, and these yields will come down. So subordinated bank debt in places like the UK, France, Germany, and in Spain and Italy still offer very good value to investors. Lastly, I would say that there is a global trend towards higher interest rates, and that will begin in the United States. So it does pay for investors to keep their interest rate exposure quite limited and therefore focus on short duration strategies in the bond market.